Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us to discuss if payment stocks are poised for a second half bounce, we have Dan Dolev is back with us, senior financial technology analyst with Mizuho Americas. Dan, it is great to see you again. Welcome back to Trade Talks.
Thanks for having me. Always great to be on your show, Jill. Thank you.
Thank you. And why do you think payment stocks are the best positioned within the tech sector for the second half of 2022?
Yeah, actually, that's a very, very good point. So, we call this, it's kind of a catchy term, but we call it FIFO, first in, first out. If you think about payments as a sector, it was one of the first sectors to benefit from COVID. So it did really well during sort of the first beginning of the second quarter of 2020. And usually the way stocks work is stocks tend to follow, or the performance of the stocks tend to follow the 2-year growth algorithm. So if you kind of combine this year's growth with last year's growth, and what you're seeing in payments is that you're basically lapping those tough compares as you head into the second quarter. And because of that, what we think, and we did a study over 3,000 stocks across 4 or 5 different subsectors of tech, payments, because it was such a big beneficiary, had the biggest dip in the first quarter, which you saw, and we're kind of the first to come out of this dip as you head into the second part of the year. And that's, in a nutshell, the explanation for why payments is so well positioned to benefit.
Dan, what about some of the risks that we're seeing? Delinquencies are on the rise, there's increasing debt loads, we've seen bankruptcies also uptick a bit. Is there any risk to that thesis for that reason?
Look, so if there's there's two sides to payments, right? There's the balance sheet side, which there's some companies that take more balance sheet risk, and there's the more fintech-y, say, network side. So on the fintech-y network side, there's definitely way less risk right now because they don't really take any balance sheet risk. So if you think about the networks, if you think about sort of the PayPals of the world, to an extent, even the Squares of the world, they're fine. There's a bit of a debate going on with the balance sheet guys. I don't think we're headed into sort of an 08 scenario. So I don't think I think the risk that people are ascribing to some of those names, like the Affirms and SoFis of the world, is way overblown, right? So you really need something catastrophic to happen for those to suffer. So I really think that the worries about this are too much. And also, if there's a macro issue, it's not just payments, it's everything. So payments on a relative basis actually faster growing than some of the other sectors.
That's a great point that you make about kind of falling into this one bucket when that certainly is not the case. Dan, what is their exposure to Russia, Ukraine, and are there any potential impacts because of that?
Yeah, that's a great point. So we actually quantified it. The most exposed names to Russia and Ukraine are Visa and MasterCard. That's about 4, 5, 6% of their revenue. PayPal, to an extent, too, low single digit. There's a very fast drop in the exposure to Russia from the U.S. payment space. So I don't think it's that meaningful overall. Maybe some Eastern Europe, but at the end of the day, it's still a drop in the bucket compared to the overall revenues.
I also want to get your thoughts on buy now, pay later. We had spoken about this a number of months back. How do you feel about that overall? It kind of almost feels like it set up a potential trap for incurring too much debt.
I like it a lot. I actually think that, again, one of those things where a lot of people are worried. We actually did some research back in 2021 that showed that a lot of people, 40% of the people using these apps have missed the payments, et cetera. But I think those apps are also getting better and better, and they have an edge. Like a company like Affirm, they have an edge in terms of their AI, their way to sort of understand and follow the consumer. And they do a very good job at actually like restricting, or lowering the risk by lowering the average duration of the loan, and actually also like fine-tuning like who they want to give loans to. So I actually think long-term, if you ask me, Joe, I think that buy now, pay later is actually a very, very strong competitor to credit cards over the next 5 years.
I also like to think that the industry is doing a much better job in terms of teaching debt management. And, we have financial literacy coming up in April, of course, Financial Literacy Month. And it feels as if the messaging is also much more aggressive than it has been in years past. Now that all these different types of payment platforms and options are available to consumers,
I think there's that optionality to consumers, especially to younger consumers, to your point on financial literacy. that's the key here. The key here is a lot of younger people, Gen Zs, millennials, and kind of younger and younger are looking at these buy now, pay later. And for them, it's just a very natural extension of credit, like account to account credit, just like credit cards was for the generations before. So it is a secular trend. It's not just a passing fad, in my view.
All right, Dan, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.